Just getting back to the CGT. So on Monday, we dealt with the basics of CGT as well as what is proceeds. Okay. So in general, how do we calculate CGT? What is the general calculation that we use? Anyone want to try? You can type it in the chat if you would like. What's the general calculation for calculating a capital gain or a capital loss of an asset? So we generally say proceeds less base cost. Well done to that student. That is correct. Okay. So before we start off with base cost, on Monday we continued, we ended up with proceeds. So I said something specific. I said with proceeds, we are allowed to reduce our proceeds amount. Can anyone remember with what amount you are allowed to reduce proceeds with? So remember, proceeds is my selling price less something to give me an adjusted proceeds. Does anyone remember what we are allowed to deduct it? Recoupment. Yes, well done. Okay, so if there is a recoupment within this transaction, you have to reduce your proceeds with the recoupment. Okay. All right, so let's have a look at base cost. Now, base cost is the cost price of the asset. Okay. I think you all know by this time what is the cost price of an asset. It's the amount that you pay. If there was any moving costs, if there was any improvements to the asset, that is all part of the cost price of an asset. Okay. Then it says if an asset is used for business purposes, certain costs can be part of the base cost, which you all already know. Any improvements or moving costs will always be part of the base cost of the asset. Then it says, but you cannot add to the base cost if these costs were previously claimed as a normal tax deduction. So let's sit there for a while. Now, when we spoke about recoupment, proceeds, the rule was anything that was previously or is included in income dealing with this whole transaction has to be deducted from your proceeds. Okay, so everyone happy? We said recoupment was included, therefore we're allowed to deduct it against our proceeds. Now the same applies with base costs. So they're telling us the same thing. Any deduction that has been deducted in the taxable income based on this transaction or this asset that we are dealing with you have to reduce your base cost with that amount. Why? Because then it's going to be seen as a double deduction. You're going to get the full cost price in base cost, and you're also going to get that other deduction that you've already claimed. Now, when we speak about assets, what type of deductions do we get with an asset? Can anyone tell me? So let's say I speak about a delivery vehicle that I've been using in my business. What type of deduction can I get for that delivery vehicle? You can put it in the chats, or you can put your mic on and speak. It's a small class, guys, so don't be shy. You can ask as many questions as you want. Okay, so let's take one step back. When I purchased a vehicle, it's a capital asset in my business. What am I allowed to claim on that vehicle? Because as you know, when I purchase a vehicle, I can't just deduct the full cost price. It's capital in nature. But what deductions am I allowed to get for the vehicle? Anyone want to try? We've been doing it before CGT. Before your test 2, we did it for like 2 weeks. Wear and tear allowance. Well done. Okay, the wear and tear allowance, we're allowed to claim a deduction of the cost price through claiming the allowance. Okay, so at the end of the day, what does the rule tell us now? The rule says, okay, if you have claimed allowances on this asset, you have to reduce your base cost with those allowances. Okay, everyone happy with that rule? So basically, your base cost most of the time will always equal to your tax value. All right. Now what happens if a recoupment lands up on a negative amount? So when we calculate recoupment, it lands up on a negative amount. Can anyone remember what we used to call that? So if it's not a recoupment, it's a negative amount. What do we call that? Deferred recoupment. Okay, so a deferred recoupment is when we add the recoupment slowly into taxable income. So I'm specifically speaking about when you work out your recoupment calculation and the calculation lands up on a negative answer. So now it's no longer a recoupment, we call it something else. Do you remember what that is? Okay, remember it's a section 11O. Thank you for that, student. You remembered section 11O, correct. Okay, so now we go one step further and we say, okay, so when it comes to base cost, it says anything that was previously deducted or currently deducted under my tax column, I need to reduce my base cost with. So can you see that if your recoupment lands up on a section 11O, which is a deduction, 11O is a deduction, we must also reduce our base cost with section 11O. So very important, make a note for yourself. What is your base cost going to equal to? Base cost will equal to your cost price minus all your allowances minus section 11O. Okay. If it is a recoupment, then you're going to deduct the recoupment from your proceeds. Okay, so make a note of that. Then this slide was just put here just to just so that you remember what allowances you guys have studied, section 11E, 12E, 12C, and then we did buildings. Okay, only one building is not included here, which is the factory building. All right, manufacturing buildings, but these are the allowances you can claim. Okay, so before I start with this slide, I just want to make sure that everyone understands that what base cost can be deducted. Base cost is equal to cost price less all my allowances less my section 11O. Is everyone happy with that? Just put a thumbs up or say yes, so I know that I still have your attention. Okay, thank you. I do have a hand up. You may ask your question or you can. Was that just to say yes, you're happy? All right, guys, so that is base cost. So that is the reason I say most of the time base cost will be equal to tax value. But if there is a section 11O calculation, then it can't be equal to tax value because now you got a further deduction on your base cost. So please remember that. But 95% of the time, base cost will always be equal to tax value if there is no section 11O. Okay, so when it comes to base cost, we've got two types of assets. We need to determine when was this asset purchased. So we have an asset that could be purchased before 1 October 2001. We call this a pre-valuation date asset. And we also got assets that were purchased after 1 October 2001. Now, why is 1 October 2001 so significant? It's because this is the date that CGT came into practice. So capital gains tax came into practice on this date. So what happens if I'm selling an asset today that I purchased before 1 October 2001? That means I need to get a revised amount for this asset on 1 October 2001, and now I need to work with my new amount and work out my base cost going forward. Okay, so let's look at the easy one first. What happens if I purchase the asset after 1 October 2001? Well, then it's going to be simple. My base cost is going to equal to expenditure actually incurred in acquiring the asset, and let me just add here, and any improvements. improvements. Okay, just add that to there. All right, so base cost is going to be simple. It's going to be your cost price plus any improvements that you had, less my tax value, less all your allowances, less section 11. That's a straightforward calculation. But what happens if my asset was purchased before 1 October 2001? So it's a little bit tricky here, but it's not a difficult calculation. So step one, I need to determine what is the value of this asset on 1 October 2001. So how do I determine that value? Okay, you're going to use 3 steps. So the 3 methods that will be used to determine valuation date value, so we call it the valuation date value on 1 October, is going to be TABC formula, market value on 1 October 2001, or 20% of proceeds less expenditure on or after 1 October 2001. So what you're going to do, you're going to write down these amounts and you're going to choose the greater amount. And that is going to be your valuation date asset. That is going to be the value of that asset on 1 October 2001. Okay. Once you have determined the base cost on 1 October 2001, then you're going to ask yourself, okay, was there any improvements to this asset after 1 October 2001? If there was, you're going to adjust it again. Why do we do that? Because now we need to know what is my base cost on the date of sale. So let's say I sell my asset in 2010. Okay. So now you've got a cost that you've just worked out here, and that cost represents the cost for 1 October 2001. But now I sell the asset in 2010. That is like what? 9 years later. Okay. What happens if I had improvements during that time? And this is where it comes up. So then you're going to say, right, improvement is going to equal to my valuation date asset, the new price, base cost, plus any improvements to give me my base cost on the date that I sell my asset. Then obviously you're going to minus your allowances and you're going to continue with the same process. Minus allowances, minus section 11O. Okay, so when we deal with base costs, it's simple. Students, what you need to ask yourself is, when did I purchase this asset? If you purchased the asset after 1 October 2001, then it's very simple. Your base cost is going to be simple. It's going to equal to cost price plus any improvements, less my allowances, less section 11O. Okay. If you purchased it before 1 October 2001, then there's a bit more calculation you need to do. So number one, we first need to determine what is the value on 1 October 2001. How do we do that? You choose the greater of the 3. Once you have determined the greater of the 3, you ask yourself, was there any improvements after 1 October 2001? If there was, you add it to that cost, and then you get your adjusted base cost. And now from there, you're going to minus your allowances and minus section 11O. Okay, everyone happy with this process? Just now we're going to do some calculations so you can see the numbers coming in. Is everyone happy? No, what is it that you don't understand? Okay, so for the student who said no, what is it that you don't understand? If you can clarify exactly what you don't understand, so I can explain again. Pre-valuation before 1 October 2001. Okay, so basically, if you purchased your asset before this date, right, that means we need to determine the value of that asset on 1 October 2001. So let's say you purchased it in 1999. Okay, you're happy if you purchased it in 1999. You happy it's a pre-valuation date asset, right? So now that you know that, you need to ask yourself, I need to determine a value on 1 October 2001. So I need a new value for this asset. Why are we determining the new value on 1 October 2001? It's because that is when CGT came into law. So that means I need a value on the start of that date, on the start of that when the new law came into place. Okay? So how do I determine that value? The way I determine that value is I need to perform a calculation. So it's going to be the greater of TABC, which I'm going to explain to you now. Okay, guys, someone has got their mic on. Please, can you turn it off? Okay, thank you. All right, so how do we determine this value on this day? We're going to use the greater of TABC, market value, 20% proceeds. I'm going to go through this calculation now with you. Just for now, I want you to remember that we're going to choose the greater of the 3. Once we have selected the greater, that is the value on 1 October 2001. So now I start with a new value as if I actually purchased it on 1 October 2001. So I start with a new cost price, basically. Okay. Now you need to say, now I'm selling it maybe 3 or 4 years later. So now I need to determine during 2001 and during up until the date that I sold it, was there any improvements to the asset? So cost price that I need to capitalize. If there was, you're going to add it to that cost price of the base cost. So now your cost price will increase. Then at the date of sale, you're going to have your new cost price minus, plus any improvements to give me my cost price. Now that you sell it, what is base cost? It's going to be your cost price that you've just determined minus your allowances minus a section 11O if there was. Okay, so that is the process there. Okay, I hope you understand better there. So I just want to tell you, what does TABC mean? Now, for this group, we are no longer required to work it out. Okay, so in the exam, an amount will be given to you. Okay, so we will tell you TABC, the answer to that formula is so much. You do not have to calculate it. I have just put it here in case you are more interested to know how do they actually calculate this TABC formula. This is the formula they use. And basically, this is what the letters mean. So it's like B is before, so expenditure after 1 October 2001, that was generally the cost price. P is going to equal to your proceeds, how much you actually sold it for. N is the number of years from the date that you bought it up until 1 October 2001. And T is the number of years from 1 October 2001 up until the day you sold the asset. Okay, so just please make a note. You do not need to know this formula. You do not need to calculate it. I will give you the answer to this formula, the amount. Okay, so what is important is that if you work on past papers and past test questions, and they do have this formula, please remember you do not need to know how to calculate it. I will give you the amount. Everyone happy with that? Okay. So let's do an example. ABC Limited bought a factory on 1 June 1992 for 200,000. Okay, so we stop here. When did we purchase it? We purchased it on 1 June 1992. So everyone happy? This is before 1 October 2001. So what does that mean? My base cost, I need to determine first my base cost on 1 October 2001. Then I need to adjust it up until the day that I sell it. Okay, so this is a pre-valuation date asset. They sold it on the 30th of March 2007 for 550,000. On 1 October 2001, the market value of the factory is 305. So can you see I already give you the market value? Okay. Then it says improvements to the value of 20,000 was done on 1 June 2006. So that means we had improvements after 1 October 2001. ABC did not claim any capital allowances on the factory, so it's not a depreciable asset for tax purposes. The TABC calculation amounted to 402,500. So there I give you the amount of TABC. Now, what is it that you only really have to calculate when it comes to base cost? It's this one here. Let's go back here. 20% of proceeds. So what does this formula mean? It's saying your proceeds, the amount you sold the asset for, less expenditure on or after 1 October 2001. So basically, if there was any improvements after 1 October 2001, you're going to less it, and then you're going to multiply your answer with 20%. Okay. All right, so my question to you is, number one, is there any, will there be any recoupment or section 11O in this calculation? Yes or no? Will there be any recoupment or 11O calculation in this question? You can just say yes or no. No. Okay, you're correct. Why is it no? Well, because number one, they tell us, okay, that there's no allowances. But you must remember, when an asset does not have any allowances, it means there will never be, we never have to calculate tax value. We never have to calculate recoupment. Okay, why? Because it's not written off. So what do? We go straight into CGT. We work out proceeds less my base cost to determine the gain or the loss. So you're going to skip all the steps where you have to work out tax value minus recoupment. You're going to skip that and go straight into CGT. The reason is because there's no allowances on the asset. So there's no need to perform those calculations, right? Tax value will always equal to cost price at the end of the day. Okay, so let's have a look at our solution. So remember, because this is a pre-valuation date asset, we first need to determine the amount of the asset, the value of the asset on 1 October 2001. And how do we determine that? Well, we have to say the greater of, and please write this in, the greater of TABC, which is 402,500. I gave you that amount. Market value on 1 October 2001, which is 305. I also gave you that amount. The only one that you need to work out is 20% proceeds. So proceeds less expenditure after. Was there any expenditure after 1 October 2001? So was there any improvements? Yes or no? Guys, was there any improvements? Yes, there was. How much was the improvement? 20,000. Well done. Can you all see my the slide still? Because I'm getting a message to say that Windows is not sharing anymore. I just want to make sure. Can you still see my slides? Yes or no? Okay, thank you. All right, so the improvement there was 20,000. So how do we do this calculation? We say proceeds, which is 550, what we sold it for, less my expenditure, my improvement of 20,000 to give me 530 multiplied by 20% to give me 106,000. So this 106,000 is what? It's the value on 1 October 2021. Everyone happy with that? That is my value. Now I need to determine what is my final value on the date that I sell it. Okay. So what is my final value going to be? So, sorry, that's not the final value. I'm wrong. Let's just do this. I don't want to confuse you now. Okay, before we determine final value, number one, which one is the greater one? Is it TABC, market value, or 20% proceeds? Which one will you choose as a student? TABC. Okay, correct, because it's the greatest one. So we say, therefore, my base cost is going to equal to what? TABC plus expenditure after 1 October. So basically, this is my answer. This one here is going to be my value on 1 October 2001. Now that I've determined the value on 1 October 2001, which is the greater one, now I need to determine my base cost on the date that I sell it. So what does the rule say? It's going to be the value on 1 October 2001, 402,500, plus expenditure after. Everyone said yes, there was expenditure, there was an improvement of 20 to give me my final cost price, base cost of 422,500. Okay, because this asset is not depreciable, we don't minus any allowances and there's no recoupment calculation. So therefore, there's no 11O amount. Does everyone understand now how to work out the base cost with a pre-valuation date asset? Is it much clearer? Yes. Okay. All right. So that is it for base cost, guys. So in a nutshell, if the asset was purchased after 1 October 2001, it's simple. All you're going to do is you're going to say, right, my base cost is equal to my cost price plus any improvements, minus any allowances if there was, minus Section 11O. If you purchase the asset after 1 October 2001, then that's going to be simple. You first need to determine the value on 1 October, the greater of the three, and then you continue with your calculation. Okay, that is base cost for CGT. Now we're going to speak about something called rollover. Now, you've already came across this already when we did recoupment. So someone mentioned it earlier, deferred recoupment, okay? Who can tell me when we deferred the recoupment, what were the two requirements that had to be met to defer a recoupment? Does anyone remember? So if we wanted to defer the recoupment, what is the two requirements? You're welcome to put on your mic and tell me, or you can type it in the chat. Okay, let me help you a bit there. So remember, if I want to defer the recoupment, number one, there has to be a replacement asset. So I'll give you the first one. What was the other requirement? Anyone remember? Okay, there must be a replacement asset, correct. And the other requirement was? We have to elect. So somewhere along the question, I have to say, the company wishes to defer tax where possible, or the company wishes to apply paragraph 65 or 66. Okay. Is there someone that would like to ask a question? All right. So please just remember that. For deferment, the only two requirements is there has to be a replacement asset and the asset has we have to defer. Yes.
Ma'am, can you please elaborate further on the concept of recoupment? What is it and what does it do?
Okay, so recoupment we did before your test 2. Recoupment is equal to selling price limited to cost price less tax value. Do you remember that?
Yes, ma'am, I do.
Yes, so that is what I'm speaking about.
I'm saying the concept of
the deferment.
Yes.
to defer the recoupment?
Yes, please.
Okay. So basically, if you work out a recoupment, the general rule is that you need to include it in taxable income 100%. But if we replace the asset that we've just sold, or it was stolen or whatever, if we replace it and we elect for deferment to apply, it means that I'm only going to put a portion of the recoupment in income. Okay, I'm not going to put the full amount in income. So do you remember how I determine how much to put in income? What do I have to look for to determine how much goes into income with deferment? Do you remember?
And I don't.
Okay, so remember, if the asset was replaced, we're going to use the replacement assets taxable allowance. So let's say there is a manufacturing machine and you replace it with another manufacturing machine. That replacement asset is written off at, let's say it's new, so it will be 40% this year. So the same tax value, the same tax allowance percentage we're going to use to defer the recoupment. We will also only include 40% in income. Okay, so that was the general thing that we did when we did capital allowances and recoupments. All right, that was also in your test too. So that was the general rule there. So those two requirements have to be met. So if I look at my slides with deferment, and that is why I went back to recoupment to remind you of what we did in that class, to defer. So if you're going to defer a recoupment, you also have to defer your capital gain as well. Okay, so whatever you do with the recoupment, you also do with your final capital gain. Okay, so just a recap. Remember when we did the deferment, there were two types of disposals. We had paragraph 65 and 66. So remember, paragraph 65 was involuntary, meaning it's not in my control. So maybe a storm came and the roof went off with the wind and it destroyed some of my assets, or maybe there was a flood that destroyed my assets, or someone came in and stole my assets. That is involuntary. I'm not in control of such disposals. But voluntary means I am in control. I can choose that tomorrow I want to sell that asset, or tomorrow I want to donate it. Okay. Now remember, at the end of the day, whether it's either one, at the end of the day, the tax effect is exactly the same. There's no different. So if there's a deferment, you will defer the recoupment. In either scenario, it does not matter. Okay, so on this slide here, I just explained more what is involuntary, which I've just done now. And then we get to an example. So let's have a look at this example. It says calculate the capital gain to be included in taxable income for Company B. Company B wishes to defer the payment of tax where possible. Company B's office building burns down. The insurance payout of 2 million is received and the capital gain is 1 million. The company buys a new office building and brings it into use to the value of 800,000. During the year, the company claims a capital allowance of 10% on the new asset. So my question to you is, are we going to defer in this question, yes or no? Yes or no? Will we defer in this question? Okay, yes, we will defer. Why will we defer? Well, simple. Why are we going to defer? Because number one, we replaced the building. Okay, so it burnt down and then we got a new office building. So we replaced it. So first requirement is met. And the second requirement, I say, we wish to defer the payment of tax where possible. So the second requirement is met. So because both requirements are met, I'm going to defer. Okay. So in this question here, I give you the capital gain of 1 million. So you don't have to calculate it. I give it to you. So please, can you tell me, out of the 1 million, how much am I going to defer? So how much am I only going to include in my tax, as my capital gain? Can anyone tell me, or maybe give me the percentage? How much will it be? Yeah, I've got a 40%. Anyone with anything else? Anyone say anything else? How much are we going to defer? So let's go back. What did I tell you? If you want to determine how much to defer, what do you need to look for? You need to look for the replacement assets tax allowance. So what did we replace this factory with, this building? We replaced it with a new office building to the value of 800. And then I tell you, we claim allowances of 10%. So there's the allowances of my office building. We are going to defer it by 10%. Okay. Okay, so how will my solution look? I'll say my capital gain multiplied by 10% because that is how much I'm going to defer. I can only include 100,000. Now, after including the 100,000, only now do I apply the inclusion rate of 80%. Only 80% of 10% is going to go into my taxable column. Okay, so it's important that you remember your framework. So if we have to go back to, where's that slide? If we have to go back to this slide here, this is your framework. For each asset, you'll say proceeds less base cost to give me a gain. If you've got another asset, again, you'll say proceeds less base cost. Then you're going to say my total aggregate capital gain or loss. It depends what you land up here. So you'll add up all your gain minus all your losses, and you will determine, do you land up on a gain or a loss? Please remember, we must say aggregate. Very important to say the correct terminology and write it down. Less assessed loss brought forward from the previous year to give me a net capital gain or loss. Out of the net capital gain, I'm only going to include 80% in my taxable income column. Okay, so where does that deferment fall? The deferment will fall here after calculating your gain. Then only will you include the deferred portion. And then only do you include 80%. So that's important. Now, if you have multiple assets, okay, you will do it per the asset. So as soon as you calculate the gain of the asset, if that specific asset has a gain, then you're going to defer it and you continue with your calculation. So it's important that you realize a deferment happens before the 80% comes into play. Okay, so your deferment you will put under here if there's a deferment. This is where you put it, the deferred gain, and then you continue with your calculation. Okay, so that is a very important principle to take note of there. Let's just go back to our slides here. All right. All right, so voluntary disposal, I've already explained this, what is going to happen if I decide to sell or donate. It's, at the end of the day, the tax is exactly the same. So let's have a look at a full-on question, including everything, including my recoupment, including my allowances, and my CGT. Okay. So it says calculate the tax effect of the above transaction for X limited for the 28 Feb 2025 year of assessment. Okay, X Limited purchased a truck for 800,000 on 1 Jan 2023. So let's stop there. Is this a pre-valuation date asset or post-valuation date asset? Yes, did someone ask a question? No. Okay, so please tell me, is this asset? It's post. So very important, now that we know that it's a post-valuation date asset, if I'm going to sell it, my base cost is going to be simple, right? I don't have to go and select the greater of all those three things, okay? I can ignore that. Then it tells me wear and tear that I claimed from February 2023, I claimed 33,333. In 2024, I claimed 200,000. And in 2025, I claimed 150. Now, students in general, you would have to calculate this, okay? So I just want to show you the framework and how we calculate. That is why I'm giving you the amounts for now. The truck was sold for $1,050,000 on the 30th of November 2024. So everyone happy, this truck was sold during this year of assessment, right? We're working 2025, 28 Feb 2025. So therefore, the sale happened during this year. So because now that we've sold the asset, remember, if you go right back to our capital allowances class, what was the steps you had to follow? Number one, you need to ask yourself, did I use the asset during this year of assessment before I sold it? If your answer was yes, you had to calculate the allowance, okay, which I know my allowance is 150. So you get the deduction for the allowance immediately. What was step number 2? Can anyone remember? After calculating my allowances, what do I calculate next when I sell an asset? You can type it out or you can put your mark on. What is the next step after calculating allowances? Okay, remember, the next step is to calculate tax value. After calculating tax value, what do you calculate? Recoupment, third step. When I sit on the recoupment, what is the question I need to ask myself? If I have this recoupment, am I going to defer it? If your answer is no deferment, you put the recoupment 100% in your taxable column. Now that we're doing CGT, we need to add. So the next step is going to be to calculate capital gains tax, proceeds, and base cost. Okay. So I hope you understand now why I said it's so important that you understand capital allowances and recoupment. Why? Because capital gains builds on top of those two topics. Okay. So a question like this can go for up to 15 to 20 marks, starting from capital allowances right up until CGT. Okay, so those are the steps that you need to follow. Okay, then it says, and a replacement truck costing 500 was purchased and brought into use on 1 December 2024. Wear and tear claim for the 2025 was 100,000 for the new asset. The company elects to defer the capital gain and the recoupment as per paragraph 66. Calculate the tax effect. So first question, am I going to defer the gain, the recoupment and the gain? If there is a recoupment and a gain, am I going to defer it? Yes or no? Guys, am I going to defer the gain? Yes or no? So what do you need to ask yourself? Did we elect for deferment and was there a replacement asset? Okay, yes, thank you for the student who answered. Yes, we're going to defer it, right? There was a replacement truck and we also elected. So now we know we're going to defer it. Okay, so what is step number 1? Like I said, the first thing you need to do is determine the allowance. Yes, I used it. I get the full allowance for this year of assessment. So let's look at our solution. Wear and tear on the old truck, 150. Step number 2, work out your tax value. My cost price, less all my allowances for all the years of assessments, 2023, 2024, 2025, to give me a tax value of 416,667. Now I need to calculate my recoupment. Recoupment, proceeds limited to cost. Are you going to use your proceeds or are you going to limit it to cost? What are you going to do here? Can anyone tell me? I sold it for 1,050,000. My cost price is 800. Which amount will you use for the recoupment calculation? . 800, correct. Thank you for that. 800 Rand, 800,000. Okay, why? Because it's limited, right? Limited to cost, so we're going to use 800 less my tax value that I've just worked up on the top to give me a recoupment of 383,333. Now we all said that it's going to be deferred, right? How do I determine how much will be deferred? Now, this is the first question in tax that you see that I actually give you the amount that we claimed. I don't give you a percentage. Okay, but from accountancy, if you are given the depreciable amount and the cost price, you're able to work out the percentage, right? So we just have to work it out backwards. Now, the cost price of the new truck was 500 and we wrote off 100. So everyone happy, we actually wrote off 20% of the truck. Okay, but let's not complicate things. So what do we do here? Wear and tear on the new truck, we get the full deduction there. Why? Because we brought it into use this year. How much of the recoupment are we going to defer? Well, once again, it depends on the replacement asset. The replacement asset, we only wrote off 100 over 500, so you need to apportion. So therefore, we only include 76,667 as my recoupment. Okay, deferred recoupment. Now my next step is to calculate my capital gain. So what is my first step in capital gain? Proceeds less base cost. So what is proceeds? It's my selling price less my recoupment. Was there a recoupment in this question, guys? Yes, there was. My recoupment, my total recoupment was 383,333. So what do I say? I say my selling price of 1,050,000 minus recoupment. Please take note, students, you never use the deferred recoupment. You will use the total recoupment. Okay? So make a note for yourself there. So to give me my final proceeds of 666,667, my base cost is going to equal to my cost price less all my allowances. So basically my base cost is actually equal to my tax value here. So where did I get this 383,333? I got it from all these allowances here. You need to add them all up and then you minus it against the cost price to give me a new base cost of 416,667. Now we said that it's deferred, right? So what is my final gain? My final gain is going to be the 666,667 less my base cost of 416,667 to give me a final gain of 250. But now I'm going to defer it. So how much do I defer? Same basis as you deferred the recoupment. You're going to say deferred capital gain, 250 multiplied by 100 divided by 500. Or you can say multiplied by 20%. It's exactly the same thing. How much of the 50 is taxable? Only 80% will be taxable and will be included in my income, taxable income calculation. Okay, so this is a full-on question showing you when an asset is sold, where's your first step? Okay, so very important. If this truck had no allowances, it was not written off, so it's a non-depreciable asset, that means we would not have this. We would not have tax value. We would not have recoupment. We will not have wear and tear. So this slide wouldn't be there. What would we have? We would only have proceeds less base cost. So my proceeds would be 1,050,000. My base cost would be 800. It would be a straightforward calculation. Okay, so please remember that. Any questions on this specific question here? Okay, if there's no questions, we're going to do the class question. Now, the class question you can also get on Moodle. It is on Moodle as well. You can get the class question, but I will share it on the screen. We are going to do some questions now. So let me just share my screen. Okay. Okay. Can everyone see my class question? Carnival. It says Carnival. Is everyone able to see it? Well, now I'm back on the main screen, but I can't go through both screens. So if you can just let me know if you're able to see it. Yes. Okay, thank you for that. We're able to see it. So let's do this question quickly. Okay, so it says here, calculate the tax effect of the above transactions of Carnival CC for the 2025 year of assessment. Okay, so before I do this question, I just want to mention something to you. When we calculate our capital gain, so that small framework that I told you, if I land up on a net capital loss, so I don't land up on a capital gain, but I land up on a loss, you are not allowed to include that in your income. Okay? The rule says if you land up on a net capital loss, the loss can only be deducted against other capital gains. So if your final answer is a loss, you're going to have to carry it forward to the next year of assessment. So you're not going to say capital loss multiplied by 80%. No, you're not going to say that. What you will say, you'll say net capital loss. Under that, you'll say carried forward to the next year of assessment. Okay, please make a note of that as well. Right. Okay, guys, so let's read here. Carnival approached you for assistance to calculate the tax effect of the following transactions for the year end 31 July 2025. So immediately, what do? Write down your timeline. So my year is going to start on the 1st of August 2024, and it's going to end on the 31st of July 2025. Okay. Carnival purchased land in November 2012 at a cost of 500,000. Carnival CC sold the land in February 2025. So everyone happy, we sold the land during this year of assessment. Therefore, I need to calculate capital gains tax for 400. Now, is there any allowance on land? Yes or no?
No.
No allowance on land. Correct. So if there's no allowance, you're happy. There's no tax value. There's no recoupment calculation. We're going to go straight into CGT and work out the capital gain or loss. Okay. A second-hand non-depreciable manufacturing machine, machine A, was purchased for 190,000 and brought into use on the 30th of June 2022. It was sold for 250,000 on 1 December 2024. The asset was not subject to any tax allowances. Once again, no tax allowances, straightforward, no tax value, no recoupment, straight into CGT. Then it says here, capital, other assets sold, shares, we had a capital loss of 2.5. Delivery vehicles, we had a capital gain of 14,700. And then we had a capital loss of 5,000, which was incurred in the 2024 year of assessment. So in the previous year of assessment, we had a loss. Then it says trading stock was purchased on 1 November 2024 for 150. On 1 January 2025, Carnival took the trading stock to the value of 35 and used it in the business. The market value of trading stock on 1 Jan 2025 was 70,000 Rand. So remember, this is a deemed disposal, what we did on Monday. Deemed disposal, deemed acquisition. I will explain this just now. Taxable income before the following transaction was taken into account was 180,000. So everyone happy? We're going to start our calculation with 180,000. Okay. So let's start. I just want to know, are you able to see my solution? So if you can just put on your mic, because I can't go back to the team screen, otherwise I come off here. So if someone can just put on their mic to say yes or no.
Yes, ma'am.
Okay, thank you. All right, so here I've got my taxable income of 180,000. Don't worry about the trading stock. I'm going to come back to that just now. I just want to focus on the CGT part. Okay. So land we sold for 450,000. That was my selling price. Then my cost price of the land was 500. Very, very important, students. You must say the correct terminology. Proceeds, base cost. What does proceeds consist of? It's my selling price. What does base cost consist of? My cost price less my allowances. So please make sure you put the correct wording down. Okay. Proceeds 450 less base cost 500 to give me a capital loss of 50. Now, don't just tell me loss. You must say capital loss. Okay. Another thing, can you see my calculation is in my calculation area? It's not in my final column. Okay. So please don't make a mistake like that in the exam where you're going to put all your calculation in your final column. You'll get it wrong. Only your final answer goes into the final column. Okay. So with the land, everyone happy we made a capital loss. Then with the second-hand machine, proceeds was 250,000, base cost was 190,000, and we made a gain of 60. Then we had shares. We made a capital loss of shares, 2,500. And then on the delivery vehicle, we made a capital gain of 14,700. Now, what do I say? Aggregate capital gains. Now, what does aggregate mean? It means total. But you cannot go put total. You have to use the correct wording. Aggregate. So how did I get the aggregate capital gain? I said minus 50 plus 60 minus 2.5 plus 14,700 to give me the aggregate capital gain of 22,200. Okay. What happens if I landed up on a minus? Then I would say aggregate capital loss. Everyone with me? Now my framework says, was there any capital loss brought forward from the previous year? Yes, there was, right? In the question, what did it say? In the 2024 year of assessment, we had a capital loss. Okay. So what do we say? We say assess capital loss brought forward from 2024 minus 5,000 Rand to give me my net capital gain of 17,200. Out of the net gain, how much is going to be taxable? Only 80% will be taxable. So I'm only going to include in my taxable column 13,706. 60,000, sorry, 60. So can you see my final taxable income amount is going to include my income minus my trading stock plus my capital gain. So that is why we say capital gains tax is not a tax on its own, but it's a tax within your tax calculation. Okay, it's not like a separate tax. At the end of the day, my taxable gain is going to be added with all my other income, with all my deductions, and we're going to multiply my taxable income, the final amount, with 27% to determine how much do we owe SARS overall. Okay, so this question is a nice question for you to sit and do again. Why? Because it shows you how to do the framework of CGT, how to, this whole framework here, how to set your answers and that. So please go back, redo it again, and make sure you understand and you use the correct wording. Okay. The next time you'll see a CGT question will only be in your exam. So you need to get it right the first time in the exam. Okay, so remember that. Now let's look at trading stock. Now let's go back to the question. Now some students struggle with trading stock, and I understand it can be a difficult concept, especially when we're changing the use of an asset, okay? So before I explain this, I need you to understand a principle for tax. So the tax law says you're only allowed to get the deduction for trading stock in the year that you sell the trading stock. Okay. So I want to ask you, you students, so let me just go back to teams. in case there's any questions in the chat. When you purchase trading stock, so if I tell you you purchase trading stock for 100,000 Rand, what do you do with that in your tax calculation? Do you deduct it? Yes or no? When you purchase trading stock, do you deduct trading stock? Is that a deduction? Yes, it is. 100%. It's a deduction. What is going to happen if that trading stock is still on hand at the end of the year? What do I do? What do I do with closing stock? You add it back. Correct. So if you add it back, can you see that you actually reversing the deduction that you created in that year? Can you all understand that? If I'm adding my closing stock back, that means I'm actually reversing the deduction when I purchased it. I'm reversing that deduction because now I'm adding it back at the end of the year. Everyone with me? Yes. What's going to happen in the next year of assessment with opening stock? What are you going to do with opening stock? You're going to deduct it, correct. So can you see with my opening stock now, I'm creating my deduction again. I'm showing a deduction in my opening stock. Now, if I sell it during the year, can you see that I got the deduction in opening stock the year that I sold it? But what happens if I don't sell it, students? It's going to land up in my closing stock again. What's going to happen with my closing stock? You're going to add it back. So can you see it's going to reverse your opening stock deduction again, and you're going to get no deduction. So what I want you to realize here is that, can you see that if I do not show a sale of trading stock, can you see that it will continuously be in my opening stock, closing stock, opening stock? I need to show the sale to get it out of my stock. Everyone understand that? Okay, so if you understand that principle, let's continue with this question now. Okay. So here what we are doing here is we're basically taking trading stock and we're taking it out and we're going to be using it as a capital asset in the business now. So if I'm going to be taking trading stock out, I need to say that I need to create a deemed disposal. Now, what does the word deemed mean? It means something that I'm going to put through, but it hasn't actually happened. So basically, I'm going to show as if a sale happened, but it didn't really happen. Okay. So we call that deemed disposal for trading stock. We actually call that a recoupment. In your calculation, you're going to say recoupment. And what are you going to recoup? You're going to recoup the market value as if you sold it. But we can't say sales because a sale didn't actually take place. So what do we say? Deemed disposal, recoupment, 70,000. Now, everyone understand up until this point, when I recoup it and I show an income, that trading stock is out of trading stock now. It's no longer in my opening, closing stock. It's no longer there. I've taken it out. Okay, so if we change the use of the trading stock into a capital asset, you will always have a deemed disposal, a recoupment at the market value. Everyone happy? What happens if you take trading stock and you donate it to a PBO? Then your deemed disposal, your recoupment will always equal to your cost price. So you can write that down, okay? What happens if I take the trading stock for my personal use as an owner? Again, your deemed disposal, your recoupment will equal to cost price. Okay, so at the end of the day, you will always use market value, but only on 2 occasions do you use your cost price. That is if you donate it to a PBO, public benefit organization, or you use it for private purposes. Okay, so if I have to have a look at my solution, where is it now? There it is. I purchased trading stock. Everyone happy? Everyone agreed we get the full deduction. I purchased it. But now we change the use, so I have to show the sale What do I say? Deemed disposal recoupment, 70,000 Rand. I've taken it out of trading stock. It's out of there. It's no longer part of my trading stock. Now, what happens from the capital part of it? Because now we've taken it out of trading stock and we're using it in the business. So number one, the question did not tell me more information, but what I can tell you is on your register, on your asset register for tax purposes, what are you going to say? So let's give this trading stock a name. So let's say the trading stock was a vehicle. Every day we sell vehicles. Now we take one vehicle and we're going to use it in the business. Maybe our delivery guy will deliver parts or whatever the case may be. We're using it in our business. It's a capital asset. As a capital asset, what are you going to do? On your register, for your asset register for tax purposes, you're going to note there, vehicle cost price, 70,000 Rand. Why is it 70,000 Rand? Because deemed disposal, deemed acquisition. If I'm deeming a disposal, I'm selling something and I sold it at the market value. At the same time, I'm purchasing it back. And if I'm purchasing back, I have to purchase it back at what I sold it for, which is the market value. So in your register, this new vehicle that you took out of your trading stock, the cost price of that vehicle will be equal to 70,000 Rand, the amount that you recouped. So what are we actually doing as well? We're setting the cost price for the capital asset. Okay. Now, if I had to tell you that the vehicle, you used it for 2 months during the year of assessment, and I gave you more information, then you're going to have to calculate allowances on it. So you would say vehicle 70,000 divided by 5 years times 2 over 12 months, and you will work out the allowance. Now, in this scenario, it doesn't give us much. It doesn't tell us what type of trading stock this was. So there's really nothing to do. But what you could include in your solution, and maybe you want to write it down, you could say capital asset from trading stock, no deduction. Why? Because it's a capital asset. At this point in time, we don't know the allowances. We don't know what type of asset it is. All we know is that it was changed. Okay. So that is how we deal with trading stock to a capital asset. It's simple. Show the amount as if you sell it. The deemed disposal will be the recoupment. And then the capital asset has now got a new cost price, which will be equal to what you recouped here. All right. Any questions on that? Trading stock to capital asset. Okay, what would happen if the opposite happened? So what happens if I told you that you took your capital asset and now you brought it into trading stock? So maybe you want to write down the rules of how you're going to tackle this. Okay. So just want to do something here quickly. New. Okay. Can you all see my Word document? A blank Word document. Yes or no?
Yes, ma'am.
Yes. Okay. So maybe you only take this down, but what happens if it is a capital asset to trading stock? So you need to ask yourself, what is the normal rules if I sell an asset? Okay. What are the normal rules? What are you going to do? We've just done it now for the past 3 lessons. The first step is you're going to calculate your capital allowances. Happy? If there is capital allowances. Then you're going to calculate your recoupment. Your recoupment. Okay? So you there, recoupment. Okay. Oh, man. Recoupment. Then you're going to calculate your CGT, which is your proceeds, and base cost. Okay, I'm writing a bit fast here, typing a bit fast there. You're going to determine that. So that is the normal way we sell an asset, correct? Because once again, capital asset to trading stock is equal to what? Deemed disposal. So what am I trying to do? I'm saying that I need to show a sale as if a sale happened, even though it didn't. So step number one, how do I show the capital asset is sold? I need to do all these steps as if I sold the asset. So let's say what is going to be different here is your proceeds. What selling price am I going to use in my proceeds? Your selling price in your proceeds. Your selling price in your proceeds will always equal to the market value. Why? Because it's a deemed disposal. Everyone with me? Selling price in proceeds will always equal to market value because deemed disposal. Okay, so now you do the whole calculation. Now let's look at the trading stock part of it. When we purchase trading stock, students, what is your steps that you follow? You purchase it. What do? You get the deduction, correct? You get the deduction. So now I'm taking the trade capital asset and I'm now it's going to be seen as a deemed acquisition. Everyone with me? Deemed acquisition, meaning I purchased it, but even though I didn't really purchase it, I'm showing it as if it is purchased, okay? So if I'm going to purchase it, when I normally buy trading stock, what do? I deduct it. Section 11A, just like you have all learned. But the question here is, what amount? Can anyone tell me what amount will trading stock be equal to? Will it be cost price or market value of the capital asset? Anyone want to try? Deemed disposal, what did I sell it for, students? What did I tell you? What is your proceeds will equal to? Market value. Now, deemed acquisition, I'm buying it back. What will the cost price be? Market value. Okay, so those are the rules you follow. So at the end of the day, students, you need to ask yourself, if I'm going from capital asset to trading stock, ask yourself the question, okay, so I'm deeming a disposal for capital asset. What do I normally do when I sell an asset? You follow the same process. You do the same calculation. Only difference, selling price will be equal to market value within your calculation. Now you ask yourself, okay, now I'm buying trading stock. So what do I normally do when I buy trading stock? Simple. I buy the trading stock at what I sold it for, deemed disposal, which is going to be my market value. I get the deduction immediately. Why? Because it's a purchase of trading stock. Okay. So I hope I assisted you guys, the students, to understand this a little bit better. Okay, in your tutorial next week, you are going to do a change of use of asset or capital asset to trading stock. So please go over this. So when you go to your tutorial, you're able to understand it better then. All right. Okay, students, the next thing we are going to do quickly is, does someone want to ask a question? Yes, no? Okay, I don't think anyone wants to ask a question. All right, the next one that I want to do is this. This can also be found on Moodle as well. Okay, these are very quick questions. Each one tests something. So the theory that you've just learned, we do a question with it. Okay, the first one says, calculate the capital gain or loss on the disposal of the asset for the 2025 year of assessment. Anvil sold a non-depreciable asset for 1.5 million on the 31st of August 2024. The asset had a cost of 600,000 in June 2021. So please tell me, what type of asset is this? So please put on your mics because I can't see the chat at this point in time. So if you can put your mic on and just give me the answer. What is this type of asset, guys? We purchased it in June 2021. Anyone? Pre-valuation date asset, okay? So that means when I work out my market value, I have to choose the greater of the three categories there. Then it says the market value of the non-depreciable asset on 1 October was 1 million. The TABC value on 1 October 2001 was 642,857. The asset was not subject to any income tax allowances. Advil has a February year end. So everyone happy? We're not going to calculate tax value. We're not going to calculate recoupment. Why? This asset is a non-depreciable asset, and also for tax purposes, we did not claim any tax allowances. Okay. So let's have a look at the solution. It's here somewhere. There it is. Is it here? No. Where is my solution? No. No. Okay, let me just get the solution quickly, guys. Okay, can everyone see the solution? Yes or no? Yes.
Yes.
Thank you. Okay. So everyone happy? We go straight into CGT proceeds. So what is my proceeds, guys? Proceeds is 1.5 million, right? We got that how? It says here we sold the non-depreciation for 1.5 million. There's no recoupment, therefore proceeds is proceeds, 1.5 million, nothing to it. Now we need to work out my base cost on 1 October 2001. So what am I going to do here? So the green part is just showing you your final answer. Once you've determined the value on 1 October, what needs to be done. So let's have a look at the orange part. Valuation date value. What is the value on 1 October 2001? Greater of TABC, market value on 1 October, or 20% proceeds. Okay. So what is my TABC? I gave it to you in the question, 642,857. What is my market value? I also gave that to you in the question, 1 million. And then the third one I need to calculate. Was there any expenditure after 1 October 2001? Well, let's go back to this question. Nowhere did it say that I had an improvement done to the asset, right? So there's no improvements. So I'm going to say proceeds of 1.5 million multiplied by 20% to give us 300,000. Now you need to tell me which one is the greater. Which one would you use? TABC, market value, or 20% proceeds? Which one would you use?
Market value.
Market value, correct. So now what am I saying? I'm saying market value, therefore the greater one is market value. Students, also very important that you write this down properly. Valuation date value, greater of, because sometimes there's a mark for stating this whole calculation, okay? So it's important that you write it just like you see it here. Then you must tell me what is your greater one. Because why? What happens if maybe you make a mistake? So maybe instead of seeing, for example, this is 300. Maybe by mistake you put 1.33 million. Your calculator made an error. But then you tell me your greater one was 1.3 million. I still have to give you the mark by telling me what is your greater one, okay? Why? Because you're correct. If this is 1.3 million, it's definitely greater than the 1 million and the 642. So it's important that you write down everything. But in this scenario here, greater one is market value. Therefore, my base cost is 1 million. There's no allowances. There's no Section 11O. So it is 1 million. Final base cost 1 million. My capital gain 500,000. So the question asked me specifically to calculate capital gain. It did not ask me to calculate the taxable capital gain. But if I did ask you to calculate the taxable capital gain, then you would go one step further and you would say 500 multiplied by 80%, and that then would go into your taxable income column. Okay, everyone happy with this question? So it's a nice question to practice base cost on pre-valuation date asset. Okay, everyone happy? Just give me a thumbs up. Yes. No. Okay. Next question. So there's just 2 more questions. Calculate factory's capital gain or loss for the year ended 31 December 2025. Factory is a resident of South Africa and is not a small business corporation. Factory purchased a used manufacturing machine for 5 million on 1 November 2024 and brought it into use in the process of manufacturing on that date. Factory's year end is 31 December. In May 2025, the machine was sold to a non-connected person for 6.5 million and it was not replaced. So what does that mean, students? Not replaced. What are you going to ignore? Are you going to defer the recoupment and the gain? Yes or no? It was not replaced. Yes or no? No, thank you. The machine was used in the process of manufacturing. Assume that factory's taxable income for the year end before taking the above was 12 million rand. So we're going to start our calculation with 12. Please, can you tell me what type of machine is a used manufacturing machine? What type of asset is that, guys? 11E or 12C? 11E or 12C? 12C, correct. Manufacturing. Are you going to write it off over 5 years or 4 years? 5 years or 4 years? 5 years. Why? Why 5 years? Because it's secondhand, right? Okay, secondhand. Well done. Because it's secondhand, where's my question? Here we go. Because it's secondhand, we'll write it off over 5 years. So once again, can you see we sold this, we sold it. So we need to follow all the steps from the beginning, right? What day did I sell it? In May 2025. My year end is in December. So what is the first question you ask yourself? Before I sold this machine, did I use it during this year of assessment? And your answer is yes, you did. Now you need to ask yourself, how much allowance can I calculate? Well, when did we purchase the machine? In November 2024, which means we purchased it in the last year of assessment. So the last year I got 20%. This year I'm getting 20%. Everyone happy? So let's have a look at our solution. It's better when you look at the numbers. Taxable income, 12 million. I used the machine during this year, so I can get 20% allowance. Okay, so that's step 1, calculate the allowance. Step 2, calculate tax value. The cost of the machine was 5 million. Then I need to calculate all my allowances, 2024, the year I purchased it, 2025 for this year of assessment, 20%, to give me a tax value of 3 million. Recoupment, selling price limited to cost. My selling price was 6.5 million. I can't use it. Why? It's more than my cost. So therefore, I use my cost price less my tax value I just calculated to give me 2 million. As you all told me, no deferment. We're going to include the full 2 million into taxable income. Next step, CGT proceeds. Selling price, 6.5 million, less my recoupment of 2 million here, my recoupment, 2 million to give me my proceeds, 4.5 million. Base cost, cost price, less my total allowances of 2 million to give me a final base cost of 3 million. My capital gain is going to equal to 1.5 million. How much of this gain is taxable, guys? 80% will be included in my tax column, 1.2 million. Okay, so can you see the more questions you do, the easier it gets. You can see the framework, you can see the steps. How do we calculate? What happens if we deferred? How would the solution look? Okay, we're going to do that question now. Any questions on this one, students? Any questions? No questions. Okay. Next one, last question for today. So there's two requireds. Number one says, what would the tax effect be if the company does not elect paragraph 65? So what does that mean? The company does not want to defer tax. So the company is not going to defer the recoupment or the capital gain. And then number two asks me, what would be the tax effect if the company does select paragraph 65? The company wishes to defer the payment of tax. That means they want to defer. Okay, so what would the solution look like in 2 if we choose to defer? So let's do number 1 first. No deferment. Replay had a new and unused manufacturing machine stolen from its factory. In actual fact, I should take this. Oh, what has happened now? Okay. Sorry, guys. I'm going to take this out, unused, because it's confusing some students, this unused one. Okay. Right. Replay had new manufacturing machine stolen from its factory. The machine was purchased at a cost of 500,000 on November 2023. The machine was stolen in February 2025. So everyone happy? The machine was stolen during this year of assessment. And we purchased it in 2023. So we purchased it like 2 years ago, right? The company was insured for the full replacement cost, and the insurance paid out an amount of 627 in April 2025. All the insurance proceeds were used in acquiring and immediately bringing into use a new and unused replacement machine costing 650,000 in June 2025. So at this point in time, some students will say, okay, but we could actually defer. Why? Because we're replacing. But the problem is the requirement says we don't want to defer. So therefore, no deferment. Everyone with me? So again, it's the same as the previous question. We're going to follow certain steps. So let's go and have a look at the solution here. Right, the tax effect. The machine that I was stolen, I still used it before it was stolen, so I can still get my allowance of 20%. We purchased this machine in 2023. So in 2023, we got 40%. 2024, we got 20%. And 2025, we get another 20%. Okay, so that is how I got the 20% for the students who are wondering. Then I got a new replacement machine and I brought it into use immediately. 650 multiplied by 40%. Now let's deal with the stolen machine. What are the processes, guys? Step 1, calculate the allowance. I just calculated there. I'm done with step 1. Step 2, calculate tax value. My cost price, 500, less all my allowances, 2023, 2024, 2025, to give me a tax value of 100. Important, you have to write down the years. If you don't write down the years and you only give the allowance, there's a possibility that it will be marked wrong. We need to see which year is for which allowance. Okay. Recoupment, selling price limited to cost. I'm allowed to use, I can only use my cost again. My selling price is too great, less my tax value that I just worked out here, the 100,000, to give me a recoupment of 400. Remember, we're not deferring it, so the whole 400 goes straight into my tax column. After recoupment, what's the next step? Proceeds. What is proceeds? Selling price, 627,500, less my recoupment, 400,000, to give me my proceeds of 227,500. Base cost is my cost price, less all my allowance, all my total allowances of 400. Where did I get that, students? From here. Total allowances there. Okay. To give me a new base cost of 100. My capital gain is equal to 127,500. Multiply that by 80% to give me 102. And I think I actually changed the solution. I just want to make sure that it is 102 quickly. 127,500 multiplied by 80%. Okay, it was updated. 102,000 is going to be taxable. Therefore, my taxable capital gain 102. And I included in my taxable column. Can you see? What goes in my final column is your final answer. Everyone happy? Okay, so the next question basically says, how would your solution look like if you had to defer it? Okay, so I'm not going to go through the whole question again, but what I am going to do is I'm going to show you the differences. How would your solution look like? So here, by recoupment, instead of putting the full 400 in income, you're only going to put 40% in income, 160. Where did we get the 40%, students? From the replacement asset. Replacement asset was written off at 40%. And that is where I got it. I did not get it from the machine C. I got it from the replacement machine. Please remember that. Okay? 160. What else is different? Is the deferred capital. So capital gain. My capital gain was 127. I'm only going to include 40%, which is 51,000. And out of the 51, only 80% is taxable. So 51 multiplied by 80% to give me 40,800. All right, so remember that. Also remember, in your proceeds calculation, your recoupment that you use here will always be your full recoupment, not the deferred one. Please take note of that. Now I want to show you the difference here. The taxpayer prefers this scenario, including only 40,800, then including the full 102. Okay, so there's a big difference. That's why it's an advantage to the taxpayer when we defer, because why? We're only including in income a small portion every year. It's only going to be a small portion. So our income is not going to be so high, our taxable income. All right. So there you can see the differences, students, to see how will the solution look if we have to defer and if we don't defer. All right. Any questions on your side? Okay, I think we just made it on time to finish this class. But is there any questions that you would like to ask me? Okay, if there's no questions, please note next week's tutorial will be on CGT. So please make sure you go through the work, go through the slides, go do the questions again. And next week when you go to your tutorial, if there's any questions you want to clarify with the tutors, please ask the tutors, or you're welcome to email me as well. All right. And then remember, next week you are doing VAT. It's your last topic is going to be VAT next week and the week after as well. And then you are finished first semester. Then you write exams. So this semester has really gone quickly. Okay, so please make sure you do questions and you study hard. All right, students, and then for the students who are not yet at the beginning of the lesson, for your assignment, you're welcome to hand in your assignment in next week's classes, in your VAT class, or on Monday between 10 and 11. Okay. Where do you get the text TextTim question, guys? It's on Moodle. It's on Moodle under TextTim. Let me show you. Let me share my screen with you guys so you can see exactly where it is. It's not the first student asking me where is it. The instructions clearly said you can find the question on Moodle under TextTim assignment. So let me just go into it. Okay, here we're going to have TextTim assignment. Can everyone see my screen? You can see my screen, students?
Yes.
Okay, you go into TextTim assignments, and there it is here, TextTim assignment. You click on it, and it will open. There's the instruction there, and your assignment is further down the page, so please follow all the instructions. Instruction is also given on Moodle, and here is your question. It starts here. So you need to use this question in order to calculate your TextTim assignment. Okay, please make sure you follow all the steps. Whatever the system asks you to do, you follow the step. All the information is given, okay? So here in other information, there's a lot of extra information given here. It's not a small business corporation, so section 12E not applicable. On the ITR4, they're going to ask you, what is your industry code? All under other information here. There's industry code. Okay, there's a certificate. Cash was given to a PBO. There's our tax certificate. So this is like real life examples. Okay, then there's shareholders. So here it shows us what is the value of the shares. All right. So please make sure you complete your assignments. I always recommend that you first do the tax liability calc, and thereafter then you do the return. Okay, but you only submit your work once you've done both. Do you submit? So you save, you can log on the system, save your work, come out, go back on, but you only submit at the end. All right. So please go read the instruction as well. Even on, just go back here. Even on Moodle, there's instructions here on Moodle, what you must use. Your TextTim assignment, there's the assignment. So please make sure here's some extra information for you. All right. Here's the steps. How do you register? There's the link. Then you're going to go register first. What you must select. Please remember, put in your student email address. The one is @student.uj. Create, tick the blocks, and you're in. Please remember your password so you know how to go in and out. You always use this, this link here. It is also on the document. So the steps are also on the document. Okay. Any questions from your side, guys? Sorry, who said they're going to provide you an example of a tax return for the student that said that? I'm not too sure who said that you would get an example, but basically, if you have not been on the system before, what it does is it asks you questions. The system asks you questions. Is this business? What was the sales amount? So you're going to input all that information. And at the end, you basically, you're actually doing the tax return by answering all the questions. And that is what happens in reality. When you go into e-filing and you're doing a company's tax return, it asks you all those questions that you need to input. And once you've inputted the last thing, and you say submit, you have actually generated your return. Okay. If you're having a problem with if you're having a problem with login, just make sure you're number one using the Chrome browser, and number two, your credentials are correct, that you are using your email with your student number @student, and that you remember your password. So just go register again. If you're already registered, then it must probably be a password scenario. Email not valid, so please send me an email with your student number, email address, and then I will send it to TaxTim to verify if you have been added to the project. Okay, so if you can please email me, and then I will sort that out for you. Okay, when can you collect your scripts? You're welcome. You can collect your scripts next week. Mr. Masiela will be lecturing, guys, so maybe you can ask him. The best time would be to collect from him on a Tuesday between his two classes, so between 11:30 and like 1:45, between 11:30 and 1:45 on a Tuesday. Go to Mr. Masiela's office. You can collect it then. Okay, any other questions on your side? Okay, if there's no other questions, then I wish you all the best, right? And please remember, I'm not going to be seeing you again. The next time I see you will be in the exam, so please study hard. If there's any questions, please email me. We will also put out a notice on when we'll be available for the exam consultations and that. So keep a lookout on that as well. Okay, students, otherwise have a good day further.